Welcome to video 7 of part 2 of the EA Tax Training Enrolled Agent Exam Preparation course. Tom here back with you to discuss S corporations. If you have not watched video 6 on C Corps and you're not familiar with how C Corps are taxed, you may want to go back and watch video 6 before this one. There are concepts introduced there that will be relevant here. Sometimes C Corps elect S Corp status, and that raises some special type of tax issues. So if you don't understand C Corp taxation, you'll be a little lost in places in this video. With that said, let's begin our look at S corporations. Here is specifically what we will look at. I'm not going to read it all to you, but we're going to start with S Corps in general and look at the Form 1120S. Then we're going to cover all these different aspects of S corporations and ending by looking at Schedules K and Schedules L, M1, M2, and M3. As always, free resources from irs.gov, just two of them to talk about in this video. Form 1120S, that is the S Corporation tax return and its instructions, and Form 2553, which is how you elect to be an S Corporation, along with its instructions. I definitely recommend you get both of those forms. You look over the forms, become familiar with them, and read the instructions as well. So S corporations are often described as being a corporation taxed like a partnership because the profits and losses are generally not taxable at the corporate level. Instead, they flow through to the shareholders on Schedule K1. So in that respect, it is a corporation taxed like a partnership, but there are some important differences between S corps and partnerships. They may not seem like a huge deal on the surface, but when you're trying to decide between one entity or the other, they can make a big difference depending on what the owners want to do with the business. So we'll talk about a couple of those as we go through this video. Here is page 1 of Form 1120S. 1120S is the S Corp tax return. So we've got the normal things at the top that we usually see. And of course, then income is shown. Then you've got all of your expenses. And then that does lead to a section here where you can have some S Corp taxes. So as we said, usually an S Corp doesn't pay tax itself, only the owners do. But if you had what used to be a C Corp is now an S Corp, there can be some special taxes that come into play that we will talk about a little bit later. And then that comes down to our signature block. Of course, there are other pages. We will have a look at some of those later in this video. As a reminder of the filing deadline for an S Corp, it is the 15th day of the third month following the end of the tax year. So that is March 15th for a calendar year corp. And they can get that 6-month extension by filing Form 7004. The penalty for late filing is $235 per month or part of a month for up to 12 months. And that is per shareholder. So it's similar to the partnership return where it's per partner. Here it is per shareholder. So that can add up. In addition, if there is tax due, there's an additional penalty of 5% of the unpaid tax for each month or part of a month up to 25% of the unpaid tax. And then the penalty for late payment, 0.5% per month up to a maximum of 25% of the unpaid tax. Requirements to qualify as an S corporation, you will want to make note of these as there will certainly be questions on the EA exam about the requirements for being an S corporation. So first of all, the corporation must be a domestic corporation, a United States corporation. It has a maximum of 100 shareholders. You will want to know that number for sure. Maximum of 100 shareholders. Now you can see underneath there is this exception that family members and their estates are treated as one shareholder. So this includes lineal descendants of a common ancestor and their spouses or former spouses up to 6 generations. So you're talking about grandmas and grandpas and children and grandchildren, etc., up to 6 generations, and their spouses can all be shareholders, and they'll all be treated as just one shareholder. So it is a maximum of 100 shareholders. That's the magic number. But just know that it can actually be more than 100 because of this family members rule. All the shareholders must be individuals, estates, certain tax-exempt organizations, and certain trusts. So we will get more specific about that here coming up. Individual shareholders must be citizens or residents of the United States, so no non-resident alien shareholders. All shareholders must consent to the S Corp election. So we'll look at the form, the 2553 here in a little bit, and you'll see where all the shareholders have to actually sign the S Corp election. So they do all have to agree to it. And there is only one class of stock. So this is a big difference between an S Corp and a C Corp. A C Corp can have many different classes of stock, including common stock and preferred stock. In an S Corp, there can be no preferred stock, one class of stock, although it can differ with voting rights. So not all of the shares of stock have to have voting rights, but there can only be one class of stock. So generally it would all be common stock, no preferred stock. The corporation cannot be certain types of businesses, cannot be a bank or thrift institution that uses the reserve method of accounting for bad debts, cannot be an insurance company, and cannot be a DISC, a domestic international sales corporation. So just know those exceptions. And the S Corp has to adopt one of the following tax years. A calendar year is first. So generally, an S Corp will be a calendar year, but there can be these exceptions. So back when we talked about the different types of tax years, you'll remember those exceptions and the elections you can make. So those are listed here. But in general, an S Corp will usually be a calendar year entity. Here's a chart of who can be and who cannot be an S corporation shareholder. So here's who's eligible. Individuals, again, as long as they are U.S. citizens or resident aliens. Estates of decedents can be shareholders. Bankruptcy estates, 501c3 charitable organizations, grantor trusts and testamentary trusts can be shareholders of an S corporation. And then there's two special kinds of trusts that we'll talk about a little bit more coming up. Qualified subchapter S trusts and electing small business trusts. Then ESOPs, employee stock ownership plans, can also be a shareholder in an S corp. And then qualified retirement plans. The list of ineligible shareholders, non-resident aliens, foreign trusts, charitable remainder trusts cannot be shareholder in an S Corp. C corporations cannot be shareholders, and S corporations cannot be shareholders. So another S Corp cannot be a shareholder in a different S Corp unless we have this Q sub situation that we will talk about in a little bit more detail. Partnership cannot be a shareholder in an S Corp. Similarly, a multi-member LLC cannot be a shareholder. Of course, a multi-member LLC defaults to being taxed as a partnership, so they cannot be a shareholder in an S Corp. A limited liability partnership cannot be a shareholder, and an individual retirement account cannot be an S Corp shareholder. So a qualified retirement plan can be, such as a 401k, 403b, but an IRA cannot be a shareholder in an S Corp. A qualified subchapter S subsidiary, this is that Q sub we're talking about. Remember, normally a corporation, either a C Corp or S Corp, cannot be a shareholder in an S Corp. However, if one S Corp owns 100% of another S Corp, then that is allowed, and that is called this Q sub. In that case, the subsidiary corporation, the Q sub, is a disregarded entity for federal income tax purposes, and they do not file a separate return. So there'll just be one return filed by the parent S Corp, and it will take into account all of the activity of both companies. Now, it says it's disregarded for federal income tax purposes. There are other purposes, such as payroll and excise tax purposes, that Q sub will be recognized for. However, the EA exam is primarily dealing with federal income tax. So for federal income tax purposes, the Q sub, the subsidiary S Corp, is a disregarded entity for tax purposes. And then just that reminder that other than a 100% interest, an S Corp cannot be a shareholder in another S Corporation. We'll talk about these special kinds of trusts a little bit. The qualified subchapter S trust has all of these elements to it. There can only be one income beneficiary. Any corpus can only be distributed to that beneficiary. The income interest must terminate when that beneficiary dies or the trust terminates. Upon termination of the trust must distribute all of its assets to that beneficiary, and all income must be distributed to the beneficiary each year. So the primary thing we're looking at here is it's just one beneficiary for that trust, and that beneficiary gets everything. So it has to have that in order to be a qualified subchapter S trust. Then we have this electing small business trust. So for that, the beneficiaries can be only individuals, estates, or certain charities. An interest in the trust cannot have been purchased. It must have been acquired by either gift or inheritance. And the trustee must file an election in order to be an electing small business trust. And then potential current beneficiaries must be eligible S corporation shareholders, except a non-resident alien is considered eligible for this purpose. So those two types of special trusts, you might get a question on one or both of those on the exam. So just remember what it takes to qualify as one of those trusts. Now let's talk about electing S Corp status. We've talked throughout these videos in part 2 about electing S Corp status. And so let's now specifically see what that looks like. In order to elect S Corp status, the entity must complete a Form 2553. That form must be completed either no more than 2 months and 15 days after the beginning of the tax year for which the election is to be effective, or at any time during the preceding tax year for which the election is to be effective. The 2-month period begins on the first day of the tax year and ends on the close of the day before the numerically corresponding day of the second calendar month following that month, then add 15 days. So we're going to do some examples to see why they've gone through the trouble of using all of those words to describe 2 months and 15 days. If we're talking about a calendar year corporation, let's say, that already exists, and now it's going to become an S Corp, then it's pretty easy. They have to make their S Corp election by March 15th. So that's 2 months and 15 days. But sometimes the entity will start up in the middle of a tax year. So it'll start up on some random date like June 14th. So then you have to be able to figure out what is 2 months and 15 days from June 14th. So that's the reason for this wording the way they do. So let's look at some examples. Corporation D begins its first tax year on January 7th, 2023, and wants to be taxed as an S Corp. They must file their S Corp election by March 21st of 2023. So you start with January 7th. 2 months from then is March 7th. We look at the day before that. So we look at March 6th. Then we add 15 days. So that gets us to March 21st of 2023. Example 2 is the more straightforward one. Corporation E has been filing as a C Corp with a calendar year end and now wants to make an S Corp election for 2023, they must file the election by March 15th of 2023. So that's pretty easy to figure out. Example 3, Corporation F begins operations on November 8th, 2023, and wishes to file as an S Corp. They must file their election by January 22nd of 2024. So we start with November 8th, go forward 2 months. That would be January 8th. Day before that is January 7th. Add 15 days. January 22nd, 2024 is when they must file their election. In certain instances, the IRS will allow a late election. So even if you don't make the 2-month and 15-day cutoff, they will still allow the S Corp election. In order to do that, you must show reasonable cause for the late election and that the corporation acted diligently upon discovering the failure to file. So sometimes an entity means to make an S Corp election and they just somehow overlook filing the form, or they have an attorney and they think the attorney is going to file it and the attorney thinks the client's going to file it, etc. So you can have these situations where it really was a good faith failure to make that election, even though they really meant to. And so sometimes the IRS will allow that. There is actually a specific procedure for filing for this relief, and that's described in this RevProc. So it's Revenue Procedure 2013-30. It's also described in the instructions to Form 2553. And the IRS doesn't have to grant this, but they usually will if you really do have a good reason for being late, and you can show that once you discovered that you didn't file, that you took the steps you needed to in order to file that Form 2553. Speaking of the 2553, let's have a quick look at it. So it starts at the top with the basic name, etc., information. Then you choose your tax year. Then you have to name someone as a legal representative to talk to the IRS. Then here we have Section I. So this is where if you are filing late, you can give your reasonable cause. So you can state your case. So you can see that late filing of these is so common, they've actually built in a good portion of this form to filling in your reasoning for the late filing. And then at the bottom, we have the signature block. Then we come to page 2, and this is where all of the shareholders have to sign. So remember, 100% of the shareholders, all of them, must consent to the S Corp election. And here is where they sign to show that they do, in fact, consent. Once the S Corp election has been submitted, so the 2553 has been submitted, the IRS should notify the company of their acceptance or non-acceptance within 60 days. So if the corporation doesn't hear back within those 60 days, they should call the IRS to inquire. And when they send in the 2553, it should be sent in by certified mail, return receipt requested, or by a comparable method with a private delivery service such as FedEx or UPS in order to establish proof of timely filing. And I would just say this is true no matter what you're sending to the IRS. If you are sending something to the IRS, go ahead and send it certified mail, return receipt requested, because you want to be able to prove in case they didn't get it. Let's face it, the IRS is a large bureaucracy. Things can get lost or misplaced. And so you want to be able to show proof of filing. And so you want that return receipt so you can show that, hey, look, we mailed it on this date. You signed for it on this date, so we know that you received it. Revocation or termination of an S Corp election. An S Corp will cease to be an S Corp and revert to being taxed as a C Corp if any of the following happen. First, if the shareholders revoke the election in writing. Second, if the corporation no longer qualifies to be an S Corp, so they don't meet those qualification criteria anymore, they'll then revert to being a C Corp. Or third, for former C corporations with accumulated earnings and profits, the corporation violates the passive income restriction. So we will talk about each of these here coming up. Once the S Corp status is terminated or revoked, the corporation must wait at least 5 years before again requesting to be an S Corp. So you will want to remember that number, that 5-year number. Once they're no longer an S Corp, they have to wait 5 years for making another S Corp election. And the IRS may allow exceptions at its discretion in certain cases. But the rule you'll want to remember for the exam is the 5-year rule. So revoking an S Corp election. A S Corp can choose to terminate their S Corp election, and they do that if shareholders holding more than 50% of the company's stock make that revocation. So here it does not have to be 100% of the shareholders. It has to be shareholders holding more than 50% of the stock. So it's not the more than 50% of the number of shareholders that counts, because remember, they can have different numbers of shares of stock. So it's shareholders holding more than 50% of the stock can revoke the election. So you will want to remember that to make the election, it has to be 100% of the shareholders. To revoke the election, it has to be more than 50% of the stock. Those shareholders have to agree in order to revoke the election. In order to revoke, the corporation files a statement requesting to revoke, and the shareholders sign a consent statement. This revocation must be filed by the 15th day of the third month of the tax year to be effective as of the first date of that tax year. So if it's a calendar year, they would have to file that by March 15th. If they file it after March 15th, then that revocation will be effective for the following tax year. Termination. So if an S Corp no longer meets the qualification, then they will terminate to be an S Corp, as we already talked about. So an example would be S Corporation G sells new shares of stock to new shareholders, bringing its total number of shareholders to 105. What was the magic number for an S Corp? It was 100. So now they've gone over that. They've got 105 shareholders. So the corporation no longer qualifies to be an S Corp and will revert to being a C Corp at that point. Inadvertent termination. So if an S Corp inadvertently does something that terminates their S Corp election, and they take steps to correct the problem within a reasonable amount of time, then the IRS may allow the company to maintain its S Corp status. So, for example, Joe, a shareholder in S Corporation H, sells his shares to Patrice, who, unbeknownst to the company, is a non-resident alien. By law, this terminates the S Corp election. Remember, you can't have non-resident alien shareholders. A few weeks later, the company discovers Patrice's non-resident status and takes steps to buy her shares back. The company can request permission from the IRS to disregard the inadvertent termination and thereby to keep their S Corp status. So the IRS does not have to grant that, but they can. And usually, if it really is an honest inadvertent termination and you really did take those steps to correct it once you found out about it, usually the IRS will allow you to maintain your S Corp status, but they don't have to, and you have to request that. Passive income restrictions. When a C corporation converts to S Corp status, it may have accumulated earnings and profits, E&P. Remember, we talked about that in the C Corp video. So it may have accumulated E&P, which was never distributed to the shareholders, and therefore it was never subject to double taxation. Once it becomes an S Corp, if passive income, so interest, dividends, capital gains, etc., exceeds 25% of gross receipts for 3 consecutive years, then the S Corp election terminates on the first day of the 4th year. This is to prevent shareholders from avoiding tax on profits earned as a C Corp that would have been taxed if it were still a C Corp. So, what they don't want corporations doing is converting from C Corp to S Corp in order to avoid double taxation. So, if a C Corp has a bunch of investments that they are earning income on, and they want to be able to accumulate those earnings without distributing them out to the shareholders and without paying a second tax, then they might want to convert to S Corp status and then just let those earnings accumulate and eventually maybe distribute them out, which is now an S Corp. So, as we'll talk about, those distributions are not taxable and they could thereby avoid double taxation on those profits. So, this is trying to say, no, we're not going to let you do that. If your passive income is more than 25% of your total income for 3 consecutive years, then we're going to assume that you're just doing this in order to avoid double taxation. So you are going to revert back to being a C Corp. So that is the purpose of this rule. We'll talk a little bit more about this passive type income a little bit later. Pass-through items. So as with a partnership, as we already said, the income from the corporation is going to flow through and pass through to the shareholders of the corporation on Schedule K1. So each shareholder shares in the profits or losses of the corporation in proportion to their percentage of ownership. So unlike a partnership, the profit sharing percentage cannot be different than the ownership percentage. So remember, when we were talking about partnerships, we had an example where one partner had 1% of the capital interest in the partnership and the other partner had 99%. But when they did their profit sharing percentages, one partner had 25% and the other partner had 75%. So with a partnership, you can do that. You can have different profit and loss sharing percentages than ownership percentages. With an S Corp, you cannot. If someone owns 1% of the S Corp stock, then they get 1% of the profits and losses. You can't change it. And so that is a key difference between an S Corp and a partnership. But then, whatever those percentages are, the profits and losses flow through to the shareholders' separate income tax return via the Schedule K1, just like on a partnership. And those profits are taxable even if little or no cash has been distributed to the shareholders, just like we saw with a partnership. Separately stated items. So, as with a partnership, certain items are not taken into account in computing the corporation's net income on page 1 of their 1120S. Instead, those items are separately stated on the K1. So, here are some examples of those: interest, dividends, royalties, etc. Section 179 deductions, Section 1231 gains and losses, charitable contributions, rental income and loss, and the alternative minimum tax preference items. Now let's talk about basis. So, as with any other type of asset, a shareholder is going to have basis in the S corporation. So, for an S corp, basis determines a couple of things. First of all, the amount of distributions that the shareholder can take tax-free. And secondly, the amount of flow through losses and deductions the shareholder can take. So S Corp basis is very important and will be tested on the EA exam for sure, and does come up in the real world all the time when you are dealing with S Corps, especially if the S Corp has a loss for the year. That's when you're really looking at basis. So this is a very important concept. With an S Corp, there are two kinds of basis. There is stock basis and debt basis. So when we talked about partnerships and we talked about basis, it was just the partner has a basis in the partnership, period. So that would be similar to what we are calling with a S Corp stock basis. For a partnership, that's all there is. It's not called stock basis, of course, because it's a partnership. They don't have stock, but it is their basis in the capital of the partnership. With an S Corp, we have that similar concept, stock basis, but then we also have this additional concept of debt basis. Those two things are computed separately and they can never be less than zero. Stock basis can be used both to take tax-free distributions as well as to deduct flow-through losses and deductions from the S corporation. Debt basis cannot be used to take tax-free distributions. So debt basis is not for tax-free distributions, but it can be used to deduct flow-through losses and deductions. And distributions are applied first, and any distributions in excess of stock basis are capital gains, no matter how much debt basis there may be. So we can't use debt basis for tax-free distributions. Therefore, no matter how much debt basis you have, if your distributions are in excess of your stock basis, then those distributions become capital gains. So let's look at a simple example to understand the difference here between stock basis and debt basis. Paul is the sole shareholder of Paul's Pretzels, Inc., an S Corp. His stock basis is $10,000 and his debt basis is $15,000, and that's from a direct loan to the company. During 2023, Paul takes a $12,000 distribution and the S Corp has a loss of $8,000. So in this case, Paul has a capital gain of $2,000 because he took a $12,000 distribution and he only had $10,000 of stock basis. So the excess distribution, that $2,000, is a capital gain. He can then recognize the entire $8,000 of loss on his personal tax return. How can he recognize $8,000 of loss if his stock basis is zero? It's because he has this $15,000 of debt basis. So assuming that no other items affect basis, at the end of the year, Paul's stock basis is zero because it started with $10,000 and he took more than that of distributions. And his debt basis is $7,000. It's the original $15,000 minus the $8,000 of losses that he took. And then note here that Paul may have been able to designate the $12,000 payment as a partial loan repayment rather than as a dividend, thereby avoiding the $2,000 capital gain. So if he had done a little bit of tax planning, he could have said, okay, instead of taking a $12,000 dividend or distribution, I'll just use that $12,000 to pay off this $15,000 loan. There'd still be $3,000 of the loan left, but $12,000 of it would be paid off. And if he had done that, he could have avoided this $2,000 capital gain, and he still could have taken the $8,000 of losses. But for purposes of our example, in order to show you how this works, Paul did not do that. He took the $12,000 as a dividend, and so this was the result. So when we are looking at stock basis, we want to know what increases stock basis and what decreases it. So what increases stock basis are the following things: any stock purchases or additional paid-in capital. So if the shareholder puts money into the corporation, then they are getting basis in their stock. I think that makes sense. Ordinary income that flows through from the S Corp. So the S Corp makes money, the stock basis increases. That's similar to a partnership. Separately stated income items that flow through to the shareholder similarly increase stock basis. Tax exempt income, so it wasn't taxable, but it is still income that does increase the shareholder's basis in their stock. And then excess depletion. And of course, there's some more particulars to that, but for the EA exam, you just need to know that excess depletion does increase stock basis. So what decreases stock basis? Distributions out to the shareholder, so dividends to the shareholder will decrease basis. Ordinary losses that pass through to the shareholder decrease basis. Separately stated losses and expense items that flow through to the shareholder decrease basis. And then non-deductible expenses decrease stock basis. So you will just want to read over those lists and understand what increases and decreases stock basis. Debt basis. So how do we increase or decrease debt basis? First of all, debt basis is created or increased by the shareholder making a bona fide loan directly to the corporation. A shareholder's loan guarantee of corporate debts does not increase debt basis. So this is different than with a partnership. Remember, with a partnership, there's only one kind of basis. But if the partner guaranteed a debt of the partnership, then the partner got basis in the partnership for that guarantee. That does not happen with an S Corp. The shareholder does not get any type of basis, stock basis or debt basis, for guaranteeing a debt of the corporation. Now, the guarantee does increase their at-risk basis. So remember, we talked about in order to take losses, you have to be at risk in the entity, in this case, in the S Corp. So the loan guarantee will give the shareholder at-risk basis, but it does not increase their debt basis in the S Corp. So how do we reduce debt basis? Two ways. Loan repayments. So if the corporation repays the loan, then that reduces debt basis. And by losses that are taken against debt basis. So remember when we had our example of Paul's Pretzels, there were losses that were taken against the debt basis, so that reduces that debt basis. Restoring basis. Once basis has been reduced, it can be restored by later profits that are going to flow through. So if both stock and debt basis have been reduced, then any increase from subsequent income is applied first to the debt basis and then to the stock basis. So you will want to remember this. Debt basis is restored before stock basis. So continuing with Paul's Pretzels, remember at the end of 2023, Paul's stock basis was zero and his debt basis was only $7,000. So let's say in 2024, the company has a profit of $15,000. Well, the first $8,000 of that is used to restore Paul's debt basis back to $15,000. And then the rest, the remainder, the $7,000, that is now Paul's stock basis because his stock basis had been zero. So his stock basis is now $7,000. So that's the way restoring basis works. Debt discharge. So remember, we said that non-taxable income generally increases stock basis. However, there is an exception for discharge of indebtedness. Debt discharge income can be tax-free. However, it does not increase shareholder basis. So you will want to remember that for the exam, that non-taxable debt discharge income does not increase shareholder basis. Distributions. So now we're talking about distributions or dividends from the corporation to the shareholder. Distributions up to the amount of stock basis are generally tax-free. Distributions in excess of stock basis result in a capital gain to the shareholder. There is an exception for former C corporations that have earnings and profits. So while usually distributions from an S Corp are going to be tax-free up to the amount of stock basis, if that S Corp used to be a C Corp and they have earnings and profits from when they were a C Corp, then those distributions might be fully or partially taxable depending on the balance in something called the accumulated adjustments account, which we commonly refer to as AAA. So, what is the accumulated adjustments account? AAA keeps track of undistributed S Corp earnings, and it is required, so the corporation is required to keep track of AAA if they used to be a C Corp that has earnings and profits. For all other S Corps, it is optional whether or not to keep track of AAA. Distributions to shareholders are not taxable to the extent there is a balance in the accumulated adjustments account. Distributions in excess of AAA are taxable if the corporation has earnings and profits. And so if they make a taxable distribution, then that will not reduce stock basis. So remember, we said one of the things that decreases stock basis in an S Corp are distributions. Well, if those distributions are taxable because they are a distribution of C Corp E&P, then they do not reduce the S Corp basis. So the important concept here is that AAA is tracking S Corp earnings, undistributed S Corp earnings. That is what is going into AAA. So if the corporation makes a distribution, it is going to be assumed first to be a distribution of S Corp earnings. And any distribution of S Corp earnings is tax-free to the shareholders because remember, they pay tax on the earnings of the S corporation, whether it's distributed or not. So when it's distributed, that is not then a separate taxable event. So AAA is keeping track only of undistributed S Corp earnings. So as long as there is a balance in AAA, then any distributions are not taxable to the shareholder. AAA is kept at the corporate level, not for each shareholder. So when we talk about basis, stock basis and debt basis, those things are kept at the shareholder level. So each individual shareholder is going to have their own separate basis, stock basis, and maybe debt basis as well. AAA, though, is kept at the corporate levels because what we're trying to figure out is how much undistributed S Corp earnings does the corporation as a whole have. So it is kept at the corporate level. AAA is increased the same way as stock basis with a couple of exceptions. So stock purchases and additional paid-in capital do not affect AAA, and tax-exempt income and expenses do not affect AAA. So AAA is keeping track of S Corp earnings. So any stock purchases or other increases in the equity that the shareholders are putting money into the corporation, those are not affecting AAA because those are not earnings. So it's earnings that are going to affect AAA, not contributions to equity. And then also tax exempt income and expenses do not affect AAA. We'll talk about those on the next slide, what happens with those. Unlike stock basis, AAA can have a negative balance due to losses, though not due to distribution. So remember, stock and debt basis can never go below zero, but AAA can go below zero if it is due to losses in the corporation. So the other adjustments account, this is what happens to those non-taxable income items. The other adjustment account keeps track of tax-exempt and non-deductible items that are not included in AAA. So even though they don't affect AAA, we still want to track them because they do affect basis. Remember when we were talking about stock basis, it was affected by tax-exempt income and by non-deductible expenses. So we still want to track all of those. So we do that in this other adjustments account. It is increased by tax-exempt income and reduced by tax-exempt expenses. It is also reduced by federal income tax paid by the S Corp for items related to having previously been a C Corp. We're going to go over those items here in a little while. So remember, federal income tax is not a deductible, is not tax deductible for federal income tax purposes, but it does reduce the other adjustments account. So now we get to the order of distributions. So when an S Corp makes distributions out to its shareholders, we need to be able to figure out, are those distributions taxable? So we need to know, where does the distribution come from? So when a corporation makes a distribution, it is assumed first to come from AAA, meaning it comes first from S Corporation earnings. So AAA tracks S Corp earnings. So distributions that come out will be assumed to come first from S Corp earnings from AAA. Once they've distributed out all of the S Corp earnings, so AAA is now gone, any other distributions that they make will be considered to come from earnings and profits. That's from earnings and profits they had while they were a C Corp. So those distributions are taxable. So they don't want you to convert from S Corp to C Corp and just avoid the double taxation from the earnings that you had while you were a C Corp. So if you distribute those earnings, those C Corp earnings, to the shareholders after you make your S Corp election, those distributions are still going to be taxable, just like they were if you were a C Corp. Once you have now distributed all of the C Corp earnings and profits, the next distributions are assumed to come from the other adjustments account. So that's from the non-taxable income as an S Corp. So those distributions are not taxable to the shareholders. So again, they are coming from S Corp earnings. It's the non-taxable portion of the S Corp earnings, but they are still S Corp earnings. And so because they are distributions from S Corp earnings, they are not taxable to the shareholder. If you now still make more distributions, so your AAA is gone, your EMP is gone, your OAA is gone, and you're still making distributions, those distributions are now a return of capital. So this is similar to what we talked about with C Corps. Remember, we said once you've distributed out all of the earnings and profits of the C Corp, anything you're now distributing is a return of the shareholders' investment in the company. So it's the same idea here. You've distributed out all of the various types of earnings. So now what you are distributing out is a return of the shareholders' investment in the company. That is a return of capital that is not taxable to the shareholder. If you are then distributing out even more, that is a capital gain, because now the shareholder has gotten all of their money back that they invested in the company, and they are getting even more money. So that is a capital gain. So that is the order of distributions. You may want to rewind the video, go back a couple minutes to where we started talking about this to make sure that you understand how these distributions come out of the company and which ones are taxable and which ones are not taxable. There is an exception to all of this that the corporation can make. They can make an election to distribute C Corp earnings and profits first. And that's usually done with a deemed dividend. Now, remember, C Corp earnings and profits are taxable. So you might ask, why would they want to distribute C Corp earnings and profits first when it's taxable, when they could instead take non-taxable distributions from AAA? So we'll talk about that. But first of all, when they do this election, they usually do it not by actually distributing anything to the shareholders, but by doing a deemed dividend. So you're basically acting as if you're pretending that you distributed cash to the shareholder and that they then turned around and immediately reinvested that money back into the company. So you don't actually have to move any funds back and forth. You just say we're doing a deemed distribution. We're going to say we distributed to you X amount of money, and you turned around and reinvested that same X amount of money back into the company. So the shareholder pays tax on that dividend, and they get an increase in their stock basis for the reinvestment. So remember, one of the things that increases stock basis is additional investments into the corporation. So this is an investment in the corporation. They took the dividend that they received and they reinvested it back into the corporation. So this is a clue as to why they may do this. Let's say the corporation has a loss for the year, and let's pretend there's just one shareholder here to make it easier to explain. So you've got one shareholder of the S Corp, and let's say that that shareholder has zero basis in their stock. So they've got no stock basis. And let's say they've got zero debt basis. So they've got no basis whatsoever for taking any losses from this S corporation. And let's say that the S Corp has a, just making up a number, a $30,000 loss for the year. Well, the shareholder doesn't have any basis. They cannot take that $30,000 loss. But what if they've got earnings and profits from when they were a C Corp? Let's say they've got $20,000 of earnings and profits from when they were a C Corp. What they can do is take a deemed dividend of that $20,000. What that does is that $20,000 is taxable, but it gives them basis in the S Corp. So now they can take a $20,000 loss. The S Corp had a $30,000 loss. Now they've got $20,000 of basis, so they can take $20,000 of that $30,000 loss to offset the dividend. So they end up with zero taxable income from those earnings and profits, because the $20,000 dividend that they got that they would have to pay tax on is offset by the $20,000 of the loss that is going to flow through from the S corporation. So that is why you would do a deemed dividend. Post-termination transition period. When an S corp election terminates, whether it's by choice or it's because the S corp no longer qualifies, the rules for distributions at that point would normally revert to the C Corp rules. So remember, we talked about C Corps. If you have a dividend, it's going to be taxable, etc. However, there is this relief that you get that during what's called the post-termination transition period, distributions from the corporation will be treated as S Corp distributions. So therefore, they're tax exempt up to the stock basis. So what they're saying here is that, okay, technically you're no longer an S Corp, but we understand that you used to be an S Corp and you just now terminated your S Corp election. So we're going to give you this transition period where even though you're technically now a C Corp, we're going to let you treat those distributions as if you were still an S Corp, which means they're going to be tax-free up to the amount of your basis in the stock of the corporation. This transition period begins on the day of the S Corp termination and ends the later of 1 year later, 1 year after the S Corp termination, or the due date, including extensions of the final S Corp tax return. So it's the later of those two dates. So basically, you're getting about a year to take distributions once you're a C Corp and still have those distributions be treated as if they were S Corp distributions. Liquidating distributions from an S Corp. When an S Corp liquidates, the same rules generally apply for liquidating distributions as other S Corp distributions. Any distribution from a complete liquidation is treated as full payment for the shareholder's stock, so the shareholder will have a gain or loss on disposition of that stock. Any previous losses which were suspended due to basis limitations are permanently lost. So if your basis had run out and the corporation had losses that you were not able to take because you didn't have basis, and now the corporation liquidates, those losses are lost forever. You do not get to offset any gain from the sale, quote unquote, of the stock from the liquidation with those suspended losses. Those suspended losses are gone forever. However, any previous losses that were suspended due to passive activity limitations, so remember, you can only take passive losses to the extent that you have passive gains. But if you are liquidating the corporation, you can use those suspended passive activity losses to offset the gain from the disposition of the stock. Next topic is S corporation taxes. So, as we have said previously, the general rule is that an S corporation does not pay federal income tax at the corporate level. So that is just like a partnership. Partnerships usually don't pay tax at the partnership level. S corps usually don't pay tax at the corporate level. However, if the company used to be a C corporation, there can be instances where the S corp itself does pay income tax at the corporate level. And these are those instances, and we are going to talk about each of these in turn. So it's something called the built-in gains tax, the excess net passive income tax, the investment credit recapture tax, and LIFO recapture tax. So let's talk about each of these. The built-in gains or BIG tax. When a C Corp elects S Corp status, the S Corp could potentially have to pay taxes on any built-in gains. So the built-in gains tax applies if, at the time of the S Corp election, the combined total fair market value of the corporation's assets exceeds their basis in those assets, and the property is sold within 5 years of the S Corp election. So if you have a C Corp that has a bunch of appreciated assets, so the assets are worth more than the company's basis in those assets, the IRS does not want that C Corp making an S Corp election in order to avoid double taxation on the appreciation of those assets. So you can't be a C Corp, elect S Corp status, turn around, sell those assets at a gain, and escape double taxation on that gain by being an S Corp. So that's what this big tax is trying to prevent. So what they're saying is, if you have these assets that are worth more than your basis, if you sell those within 5 years of making that S Corp election, then you've got to pay tax on that. as if you were still a C Corp. So you'd have to pay the 21% corporate tax on those gains. Now you might be asking, well, what if I wait the 5 years? What if I have these appreciated assets, make the S Corp election, and wait the 5 years? Then what happens? Well, in that case, you got away with it. It's allowed. The IRS is basically saying if you are patient enough to wait the 5 years, then good for you. You can go ahead and avoid this big tax. You don't have to pay the C Corp tax on the sale of those assets. But they know that most people are going to sell. If they are intending to do this, they're going to sell within the first 5 years. So that's why they make that the rule. Now, this big tax also applies to accounts receivable and payable. So if you have a cash basis corporation, then they have no basis in their accounts receivable, because when they created the accounts receivable, they did not include it in taxable income. So remember that, cash versus accrual. If you're cash basis and you sell something on credit to a customer, you don't recognize the income until the customer actually pays. So because of that, the corporation has no basis in any accounts receivable that they have. So the same rule is going to apply. When they convert from a C Corp to an S Corp, when they collect those accounts receivable, they're going to have to pay a 21% tax on that, just as if they were still a C Corporation. This does not apply to an accrual-based corporation, because they have already recognized the income as soon as they created the receivable. They made the sale, they recognized the sale as income, they created the receivable. So when they collect their accounts receivable, once they're an S Corp, there's no tax effect to that. It's only for a cash basis C Corp that then converts to an S Corp. They collect those receivables, they have to pay the 21% tax on those. Now you can also see there is an offset. When they have accounts payable, they also get the deduction for when they pay those payables, because just like with the receivable, when they created the payable, they did not take the tax deduction because they weren't allowed to, because they're on the cash basis. So once they convert to S Corp status, then they can take the deduction for those payables in order to offset the receivables that they collected. LIFO recapture tax. If the C Corp uses LIFO in its final year before electing S Corp status, then the LIFO recapture tax is due. It's similar to the big tax. It taxes built-in gains in inventory. So you'll remember when we talked about the different types of inventory, LIFO gives you the largest cost of goods sold and therefore the smallest taxable income. And it also results in the lowest ending inventory value, because in times of inflation, prices are going up. With LIFO, your last items in are considered the first items sold. So the items that are left in inventory are the oldest items. So they were the ones that were purchased at the lowest cost. So your ending inventory value is the lowest of all the different types of inventory valuation methods. So what this LIFO recapture tax is doing is saying we're not going to let you not pay your corporate tax on the gain that is built in because you chose LIFO instead of FIFO or the average cost method. So what it does is you recompute your ending inventory as if you were on FIFO or as if you were on lower of cost or market. And then you subtract the LIFO inventory from that. So the FIFO inventory value is going to be larger than the LIFO inventory value. So you can subtract the LIFO inventory value from the FIFO inventory value, and then you have to pay the 21% tax on that difference. So it's basically putting you in the same position as the corporation would have been if they had been on FIFO all along. That's what they're saying. Now, for this one, they let you pay this recapture tax in 4 annual installments. So you don't have to pay it all in the first year. So you make your first installment on the final C corporation tax return, and then you make the other 3 installments on the first 3 years of S corp returns. So remember for the exam that it's the difference between the FIFO and LIFO inventory values. Pay that 21% tax, but that you get to pay it in 4 annual installments. Next is the excess net passive income tax. So an S corp that used to be a C corp must pay the excess net passive income tax if the corporation has accumulated earnings and profits and passive investment income exceeds 25% of gross receipts, and the corporation has excess net passive income. What is excess net passive income? It is computed using a formula that you do not need to know for the EA exam. So just know that they have to have excess net passive income. Don't worry about how it is computed. So if they meet all of these things, they've got earnings and profits from when they were a C corp, passive investment income exceeds 25% of gross receipts, and they have excess net passive income, then they have to pay a tax of 21% on that excess net passive income. So remember, we talked earlier about a similar concept. We said that an S corp ceases to be an S corp and reverts to being a C corp if the S corp had passive investment income exceeding 25% of gross income for 3 straight years. So there's 2 different kind of penalties that can happen if you've got this excess passive income. The first is you can lose your S corp status if you have that for 3 years in a row, this 25% or more of gross receipts for 3 years in a row. And then the second kind of penalty is you can have to pay this tax if you have this excess net passive income. Next is the investment credit recapture tax. So an S corp can be liable for this investment credit recapture tax if, when it was a C corp, the company had an investment credit on an asset that it acquired, and the S corp sells or otherwise disposes of that asset prematurely. And so prematurely is going to depend on what the asset is and what its recovery life is, etc. So just know for the exam that if they have an asset that they took the investment credit for when they were a C corp, and then they sell it once they become an S corp and they sell it quote unquote prematurely, then they will have to pay the 21% tax on the gain. That is the investment credit recapture tax. Next topic is shareholder pay and fringe benefits. So how does that work in an S corporation? A shareholder who works in the business, they are an employee. They're included on payroll along with all of the other employees. They are not self-employed like partners in a partnership, and they are subject to all the normal withholding and payroll taxes. Shareholder pay has to be reasonable. You'll remember that we had a similar concept when we talked about C corps. So the shareholder pay must be reasonable. In other words, it has to be comparable to what an employee with similar experience, skills, and responsibilities would make at an unrelated employer in the same area. This is a common area of dispute between the IRS and the S corp shareholders. So in an S corp, as opposed to a C corp, the shareholders want a low salary so they can designate more of their distributions as dividends, because dividends are not subject to Social Security and Medicare taxes. Remember that 15.3%. If you've got a dividend in an S corp, it's not taxable. Remember, we just went through that. As long as you are distributing out S corp earnings, those distributions are not taxable to the shareholder. But if it is salary, that is subject to the 15.3% Social Security and Medicare tax. So in an S Corp, the shareholder employee wants a low salary and high dividends. This is the exact opposite of in a C Corp. In a C Corp, dividends are taxable and they are not deductible by the corporation. So in a C Corp, the shareholder owner wants a high salary because it's deductible by the C Corp and low dividends because they are not deductible by the C Corp. So it's the opposite situation. So what you end up with is if you have an S Corp, the taxpayer is arguing that their salary should be lower, and the IRS is arguing that their salary should be higher. And when you have a C Corp, is the opposite. The shareholder employee is arguing that their salary should be higher, and the IRS is arguing that it should be lower. So a lot of LLCs, particularly single member LLCs, they elect S Corp status for exactly this reason. They want to save on their Social Security and Medicare taxes. So when they are a sole proprietorship, they have to pay the 15.3% self-employment tax on all of their earnings up to the limit. The Social Security portion, they only pay up to that annual limit. But still, they have to pay that self-employment tax on their earnings if they are a sole proprietorship. So they will frequently elect S Corp status in order to be able to pay themselves a salary, hopefully a small salary, and then take the bulk of their earnings as dividends because those dividends are not going to be subject to the self-employment tax. So what the IRS says is you cannot give yourself an unreasonably small salary. You have to pay yourself a reasonable salary, which is then subject to Social Security and Medicare tax. So this is where you can get into those disputes between the IRS and the taxpayer about what is a reasonable salary. Now, one position that the IRS takes is that if most of the income is derived from the shareholder's personal services, then most of the distributions should be in the form of salary rather than dividends. So let's say you are in a service business. Let's say, for example, you're an accountant or a tax preparer, and most of your income is going to be from preparing tax returns. So you prepare a tax return, the client pays you money for that. So you are getting most of your income from providing a personal service. The IRS is going to take the position then that most of your income should be in the form of salary. Because if you were working somewhere else, you'd be getting paid for doing tax returns. Now you're working for yourself, you're getting paid for doing tax returns. And so you should be getting a salary primarily rather than dividends. Now, the shareholder can always argue about that, and they can go back and forth, and they can go all the way to court and let a judge decide if they want to. But that is going to be a line of reasoning that the IRS is going to use. So you and your clients want to think about those things when you are deciding whether or not to make an S Corp election, for example, for a single member LLC. So what about fringe benefits? For purposes of most fringe benefits, a greater than 2% shareholder is going to be treated like a partner in a partnership, which means the fringe benefits are taxable. Now, there are some exceptions to this. For instance, contributions to a qualified retirement plan would not be subject to this, and there's a few others. But for the most part, if you've got a fringe benefit that is tax-free to other employees, if you are a greater than 2% shareholder, that fringe benefit is going to be taxable to you. And you will want to remember that 2%. So it's greater than 2% shareholders are the ones who are subject to this taxation of their fringe benefits. If the corporation pays the shareholders health insurance premium, those premiums are going to be taxable to the shareholder. but they can take the self-employed health insurance deduction on their 1040, which we have talked about previously. Now, in order to do that, though, the deduction cannot be greater than the net profit from the business. But you'll remember all those rules for taking the self-employed health insurance deduction. Well, the greater than 2% shareholder can take that deduction as long as they qualify if the corporation is paying their health insurance premiums. Now let's talk about Schedules K, K1, K2, and K3. This is going to be very similar to the partnership conversation that we had. Schedule K is a summary schedule of all the shareholders' shares of the corporation's income, credits, deductions. So Schedule K is done at the corporate level. So it accumulates all of the different income and expense items of the entire corporation. Rental activity and income is not reported on page 1 of the 1120S. Remember, we saw that, and it's the same thing with partnerships. So these amounts are not combined with trade or business income that is shown on page 1. Instead, rental income is reported separately on Schedule K. So let's have a look at the Schedule K for an S Corp, very similar to Schedule K for a partnership. So it starts with line 1 is ordinary income. That comes from page 1. So that flows through here to line 1. Then you're going to have your rental real estate income on line 2. And then it's going to go down with all of your other income and expenses. So these are going to be those separately stated items that we have talked about. And then the end of Schedule K is at the top of Schedule L. So this is where it ends. And when it comes down to here is to line 18. So this is the income or loss reconciliation. So what line 18 does is it takes all of your different types of income, page 1 income, rental income, all of the different separately stated items, income and expense. So this is all income and expense items, whether they are on page 1 or whether they are separately stated. It's going to add and subtract them all together, and it is going to come up with your total income here on line 18. So that is your total income per the tax return. So that is going to be important later when we reconcile book and tax income. What you are going to reconcile to is line 18 of Schedule K. Schedule K1 then shows each shareholder's separate share of those items on Schedule K. The line item totals from all of the K1s will add up to the amount on Schedule K, and then a copy of each K1 is sent to each respective shareholder for use in filing their own income tax return. And again, you should send them a copy of the instructions for Schedule K1 so they know what to do with those items on their tax returns. And then a copy of all the K1s are attached to the 1120S and sent to the IRS. So the IRS then knows what each shareholder should be reporting on their individual tax return. This is what the Schedule K1 looks like. Again, looks very similar to the partnership K1. Starts with the corporation's name and information, then gives the shareholder's name and information. Then it does show their current year allocation percentage. So how much of the corporation do they own? And then it shows their number of shares at the beginning of year and the end of year. And if there were any loans from that shareholder, it will show up here. And of course, that is to help in determining any debt basis that the shareholder may have. Then you get over to the reporting items. So again, line 1, that is their share of the ordinary income from the corporation, and then all of the other different items and separately stated items that are flowing through from the corporation are going to show up here on their Schedule K1. Schedules K2 and K3, it's just like with a partnership. Remember, Schedule K2 is an extension of Schedule K, but it just shows the foreign source income and expenses. And then Schedule K3 is an extension of K1, showing each shareholder's distributive share of the foreign source income and expense items. And remember that everything that's in Schedule K2, all of those foreign amounts are already included in the amounts on Schedule K. This is just breaking them out separately so the IRS can see how much and which items are foreign source. And then the same way with the K3, all of those items are already included in the K1. It's just breaking them out separately so the IRS can see how much is foreign. These schedules K2 and K3 do not need to be filed if all of the following criteria are met. First of all, if there is no foreign activity or very little foreign activity, just like with the partnership. If all the shareholders are notified when they get their K1 that there is no K3 being furnished, and if none of the shareholders request a K3 within 1 month of when the 1120S is filed. So again, if you send them a K1 and say, hey, look, we don't think we need to file a K2 or K3, so we are not doing so. If any of the shareholders get back to you within a month and say, no, I actually do need the K3, then the corporation is going to have to go back, file the K2 and the K3s and send them out to the shareholders. And if you say you need a K3 this year, then you have to assume that they need one next year as well. You will notice that this list is a little bit different from the partnership list because remember, the first thing on the partnership list was that it has to be a domestic partnership. That is not on this list. Why? Because the very definition of an S Corp is that it is a domestic corporation. Remember, that was the very first requirement for being an S Corp is that it has to be a domestic corporation. So it's not being restated here. It is already assumed that it is a domestic corporation. And then these other requirements are the same as with a partnership. Schedules L, M1, M2, and M3. Again, this is going to be very similar to what we saw before. On the 1120S, the last two pages are Schedule L, M1, and M2. Schedule L, as always, is the balance sheet per books. M1, as always, is the reconciliation of book and tax income for corporations with less than $10 million in assets. If the corporation has more than $10 million in assets, then they will jump over to Schedule M3. Schedule M2 is a little bit different for an S Corp than it is for a partnership or a C Corp. Schedule M2, as we will see, is an analysis of AAA, of undistributed income previously taxed, of accumulated earnings and profits, and of OAA. So we will look at that in a little bit more detail here coming up. But first, let's look at Schedule L. Looks very much like Schedule L on a C Corp's return. So we've got assets, liabilities, beginning of year, end of year. When we get down to the equity section, it looks a lot like the C Corp one, but it's a little bit different. So capital stock here on the C Corp return, you'll remember it was broken down between common stock and preferred stock. With an S Corp, there can be no preferred stock, so it's all just one line. So this will be the par value of the common stock is what will go here. Then you have additional paid-in capital. That's the same as with the C Corp. Then you have retained earnings. So it is a little bit different. We don't have this distinction between appropriated versus unappropriated retained earnings. It's all just retained earnings on an S Corp. This is going to be for smaller corporations. And for an S Corp, since distributions are not taxable anyway, there's usually no reason to distinguish between appropriated and unappropriated retained earnings. Then you have this adjustments to shareholders' equity to pick up any random type of adjustments that you may have that are not listed anywhere else, and then less the cost of treasury stock. So those things are the same as on the C Corp balance sheet. Next is Schedule M1 and M2. So M1 is the reconciliation of book and tax income. So you'll start with your book income, then you'll have your book to tax differences, and then this is where you'll end up with that line 18 of Schedule K. So this is taking into account all of the income and loss items from the corporation, whether they are included on page 1 in the normal trade or business income or whether they are separately stated items on Schedule K. They all get included here. So we're going to reconcile our book income to that total number from Schedule K. Then we've got Schedule M2. So M2 only needs to be filed if the company used to be a C Corp. So all of the items here are going to be items that are holdovers from the C Corp or that we're only tracking because we used to be a C Corp. So you've got the accumulated adjustment account. So we already talked about that. That is going to show the S Corp earnings. So then you have the shareholders' undistributed taxable income that was already taxed, that was previously taxed. Then you're going to have accumulated earnings and profits. So this is the earnings and profits from when you were a C Corp that has not already been taxed. And then you have your other adjustments account, which of course keeps track of the non-taxable and non-deductible S Corp items. So all of those things are tracked on Schedule M2. As with our other entities that we looked at, small S Corps do not have to file Schedules L and M1. And it's just like the C Corp qualification. If the corporation has less than $250,000 of gross receipts and less than $250,000 of assets, then Schedules L and M1 are not required. However, M2 could still be required. So if you used to be a C Corp and you've got accumulated earnings and profits, then you're still going to have to file Schedule M2, even if you're not required to file Schedules L and M1. If you're not required to file these schedules, then you have to check a box on Schedule B. It just says, did you have less than 250,000 of gross receipts and less than 250,000 of assets? And you just say yes. And when you do that, you don't have to file L and M1, but of course you are still allowed to file them even if you are not required to do so. Schedule M2, as we said, is only required if the corporation was previously a C Corp and has accumulated earnings and profits. So if you were never a C Corp, or even if you were a C Corp but you didn't have any accumulated earnings and profits, then you do not have to file Schedule M2. However, the IRS still recommends that you do complete M2 because you never know what might happen in the future. So you may have a future transaction, such as where you merge with another S Corp that does have earnings and profits, where AAA will be necessary. So they advise that you go ahead and do it just in case, but that is up to you. Schedule M3, as we've seen before, Schedule M3 must be filed if the corporation has total assets at the end of the year of $10 million or more. And if they are required to file Schedule M3, then they must also file Schedule B. Also, as we've seen before, corporations with $50 million or more of assets must file Schedule M3 in its entirety. But if they have between 10 million but less than 50 million, then they can opt to complete only Part 1 of Schedule M3 and then to go ahead and file Schedule M1 instead of Parts 2 and 3 of the M3. And any corporation can file Schedule M3 if they want to, but if they do, then they have to follow the rules. We're not going to look at Schedule M3 again. We did so on the C Corp video. If you want a refresher, you can go back and watch that. And with that, that is the end of video 7 covering S Corps. Go back, watch as many times as you need to get the fundamental ideas down about basis in particular, and then about distributions and what happens with those. So I will see you on video 8.